Welcome back to The Dive. Today on the show, we have the head commodity strategist at Saxo Bank, Ole Hansen. He's going to talk to us about the rise in U.S. job openings, the strength of the U.S. dollar's impact on the global commodities market, the wheat futures price spike, coffee, cotton, and sugar, nickel, copper, oil, and of course, gold. But before we bring him on, do me one quick favor and just go ahead and smash on that subscribe button for me, please. Hey, Ollie, welcome to The Dive.
Thank you very much, Cassandra, and greetings from Copenhagen.
Oh, that's so nice. Greetings from Canada. Okay, so let's start off here. U.S. job openings rose unexpectedly in September to 10.7 million job vacancies, up from 10.2 million in August. What do you think that this means for the fight against inflation?
Well, it's most certainly going to mean that it's going to drag on a bit. It's going to take longer than probably the market is anticipating at this moment in time. At the same time, we're also having the situation from a global perspective that we got a strong dollar because we got the central bank in the US, the FOMC, hiking into strength, whereas we got other central banks hiking into weakness because they simply have to follow what's happening in the US. So this is causing the dollar strength right now. But overall, it will take longer time to get inflation under control. And I think the market right now is potentially waking up to the fact that we may have to fight inflation for longer than anticipated.
What is your perspective on the strength of the US dollar and its impact on global commodity markets?
Well, it is part of this the inflation fighting that's currently unfolding, and it's basically left the dollar very strong, and we've seen that over the past year. Normally, in a strong dollar environment, you tend to see commodity prices on the weak side. That has not been the case because commodities have been had a generally strong year as well, especially the energy sector, and that basically just means that any consumer not dollar-based is struggling with energy bills because and commodity price in general, and that's adding to the inflationary pressures that we're seeing around the world. So the strong dollar for now is a major headwind for the fighting inflation elsewhere.
We see a price spike in wheat futures this week due to Russia backing out from the Black Sea grain deal, which was later reversed. How do you view Russia's role in the commodities market? Should people be concerned?
Well, from a European perspective, where I'm sitting right now, it's unfortunately I have to say that unfortunately, yes, Russia has a major impact on commodity prices globally. Not only are they a major exporter of crude oil, and especially here in Europe, a gas exporter, not so much any longer because gas lines has been cut or been bombed. But if you just look at the food sector as well, they are a major exporter of wheat. In metals, they are export of nickel, aluminium. So yes, their impact on the global commodity market is very significant.
Okay, so let's talk about some of the charts that you have from your recent weekly commodity update. What does this chart tell us?
Well, it's basically telling us that the sector that's been doing the worst so far this year is really the soft commodity sector. In the chart, I was looking at cotton and coffee. The interesting thing about cotton is just like copper is a good gauge for the economic or the global economic outlook, because if we do see consumers start to get squeezed on their spending, they may just delay purchasing clothes and so on, and that's basically reducing demand for cotton, especially in China, which is a major manufacturer. So cotton prices under pressure, and we're seeing that as a gauge as a sign of this economic slowdown we're currently seeing. The same time, same goes for coffee. If you are getting a bit squeezed on your money, you may scale down on your buying of expensive coffee from the coffee bars, or you may make it yourself, something like that. And that's basically together with an increased an improved outlook for the production in South America has supported the production of coffee. So both of these are under pressure right now, primarily for the reasons that we are worried about the global economic slowdown.
Now, President Joe Biden said that he will seek to impose higher taxes on oil companies that record windfall profits without reinvesting in production. Can you make any sense of Biden's strategy with the oil industry? And where do you think we're heading from here?
Well, taxing oil revenues is a short-term fix to fill up some of the gaps that are missing in the budgets because because we're going through a painful time of high inflation. But what we also have to consider is that we are not going to get rid of oil demand anytime soon. We just this week saw OPEC looking for another increase, or 13% increase over the coming 10 years, and then prices, production demand will stay stable at that high level for another 10 years. If that turns out to be the case, we need significant amount of investments into the oil industry. And if oil companies are being taxed quite punitively, then the appetite for investing into longer term exploration is obviously reduced at the same time. So it's potentially a short term fix, but just creating a longer term problem.
While we're at it, let's talk about the recent news with Occidental Petroleum announcing a plant that will draw down 500,000 tons per year of carbon dioxide. If this becomes successful, do you think that we will see more carbon dioxide sequestration hubs in the US?
Absolutely, because it is a key area and a key focus in order to bring down the CO2 emission into the atmosphere. Because one thing is trying to bring down the burning of fossil fuels. Another thing is actually trying to capture the emission that comes out from production of when you use fossil fuels. So we're seeing that in Europe as well. It's still an industry which is in its infancy. We're not there yet by a million miles, but a lot of investments is going into that area, and again, it's part of the overall solution going forward to bring down CO2 emissions.
What is your read on copper and nickel right now?
Copper is interesting because it's one of the commodities that has fallen the most in a year where where the market has been worried about China because the lockdowns has just continued for much longer than expected. At the same time, copper is also called the king of green metals because it's so necessary for the transition towards an electrified world. And that these two things has really been kind of fighting against each other this year. But if we look into the future, we're potentially seeing some additional supply coming online next year from mining companies. But after that, the funnel looks pretty dry, and that basically means we are looking, I think, into a decade of progressively higher copper price, because simply it is needed in order to proceed with this electrification. So we are bullish on copper for the longer term. Nickel is, as we all know, part of the battery industry, and it's also a metal that is sourced from Russia, where we currently have some issues. So nickel as well has had an extremely volatile year, and it's one that will remain in demand. So generally, we are seeing the lockdowns in China starting to ease sometime early next year, and that I think will trigger a renewed pickup in demand for industrial metals. Copper and nickel would probably be two of the metals that would benefit greatly from that.
What is your outlook on gold going into 2023?
Gold is our bullish story for gold, which we are bullish, and we've been that throughout this weakness. We also acknowledge that gold has had a troubled year because the dollar has strengthened a lot. We've seen a significant rally in bond yields. Both of these are headwinds for gold, but at this moment in time, we're looking the market's pricing in long-term inflation in the US to come back down to around 3%. We think that we may end up in a 4 to 5% bracket, and if that's the case, then that eventually will lead to the market having to readjust their expectations for future inflation, and that's where we think gold comes in as a potential benefit to benefit from that. So with that in mind, we're seeing upside for gold into 23.
Now, Ole, before we let you go, where can our viewers go to get more of your commentary?
Well, I work for Saxo Bank, which is a global online investment bank. We have our websites, which is analyses.saxo, where you can find all the inputs from me and my colleagues covering FX and FX equities, bonds, and so on, and also cryptos. If you want to, you can join my extended family on Twitter, which you can find me there at Ole_S_Hansen SEN. And I put most of what I do on the website. I'll also post on my Twitter account.
Perfect. Okay, well, thank you so much for coming on today and sharing your expertise with us.
Thank you very much.
Thanks so much for watching today. We'll be back again tomorrow, but in the meantime, you could check out one of our other videos over there.